Hello and welcome to Week 4, Tax Credits. By the end of this lesson, you should be able to identify and describe tax credits and identify tax reduction techniques. Tax credits are available to any taxpayer, and they're very valuable because they reduce income tax owed dollar for dollar. Now, tax credits are much more valuable than tax deductions, which is what a lot of taxpayers focus on, a lot of your clients will focus on, because in contrast to the tax credit, which gives you a dollar for dollar savings on your tax bill, the deduction just reduces your taxable income upon which your marginal rate is applied. So that means, at best, in this tax environment, a tax deduction can save a taxpayer a maximum of 35 cents per dollar, or slightly more if we take into account Medicare surtaxes. So a dollar for dollar credit is much more valuable than a 35 cent per dollar credit. So wherever we can, we like to take advantage of credits. If only it were that easy. There are several types of credits that are available, but most of these credits are subject to income caps. So as we go through each of these credits, be sure to refer back to your textbook for the most indexed for inflation numbers for each of those credits. Many of your clients, especially if they have enough wealth to employ a financial planner, are going to automatically phase out of these income limitations for credits, particularly if you're practicing on the West Coast or the East Coast, and we are situated in, or at least the university is situated in California. So a lot of your clients who don't think of themselves as wealthy or high income earners, just by virtue of the fact that they're living and working in high cost areas, many of your clients are going to be phased out of these credits. But it's important to know that they're available, and not every credit is completely phased out. So be sure to check out the rest of the lesson. And also, some credits are indexed for inflation. Most aren't, but generally speaking, those income phase outs are indexed for inflation, although not always. So there are two broad types of credits. There's refundable credits and non-refundable credits. So most credits that we're going to learn about are non-refundable. So if you have a tax balance and you're eligible for one of these credits, then that's great. But if your tax balance is less than the amount of the credit, you don't get a refund. Now, sometimes a non-refundable credit, even though you can't get the refund, you can carry it forward or carry it back. Not always. Some credits are just use it or lose it in 1 year. Others can be carried back or forward. Now, there is also a sequence for claiming non-refundable credits, or all credits actually. And if you have clients who are claiming a number of credits, it's important that you're familiar with that sequence, because you don't want to take all the non-refundable credits first and then take refundable credits and get money back when that isn't necessarily the sequence. So the IRS has a way of prioritizing credits, and we all must follow that. Let's start with our first major class of credits, the refundable credits. The most common type of credit by far is the credit for taxes that you pay into the IRS. This is for your federal income tax paid, generally speaking, and that could be in the form of federal withholding from either your wages, your paycheck, sometimes interest and dividend, perhaps withholding from a retirement plan distribution. It could also be estimated tax payments that a client has made, so you can actually write checks to the IRS for credit for your tax liability for the year, and if that's more than you need, that credit comes back to you. Obviously, that's a refundable credit because that is your money, and if you were required to pay it in, but then your liability was less, there's no reason for the IRS to hold that money, so definitely refundable. The other type of credit for taxes paid has to do with Social Security tax withheld. As we learned in a previous week, Social Security is withheld on wages only up to a certain amount per year, and that number changes every year, but it's upwards of a little over $100,000 right now. If a high earning taxpayer, so someone who's earning more than $120,000, $130,000 a year, changes jobs in the middle of the year, the new employer has to start over again. So there's no mechanism to say, hey, I've already paid in $5,000 worth of Social Security taxes in my old job. Can you give me credit? It's just not an option. So don't get mad at your new employer. It's just not an option that's available to the new employer, because the employer has to pay the full amount. Remember, there's a employee and an employer portion. The employer has to pay that full amount regardless of what your old employer paid. So if you have a taxpayer who is earning more than $120,000, $130,000 a year and changes jobs, there will be too much Social Security withheld. When that happens, you actually can report that on the tax return in the payment section, and that is a refundable credit as well. The final thing I'll say about that is occasionally you do have high income taxpayers who have two W-2 jobs. So there's the main job, and perhaps they do some teaching on the side, and there's additional Social Security withheld from that second job. That would be a situation where you would see the excess Social Security taxes come back. So for one taxpayer, so this is calculated separately for a husband and a wife who are filing jointly, but if a husband can only pay in the FICA max one time, and the wife can only pay in the FICA max one time. And if more is withheld, then that credit will come back automatically to them on the tax return. So as a good preparer, we want to make sure that we enter that information and we get the refund back to the taxpayer. But eventually, usually after months, if not over a year, the IRS generally will notice this and send the refund. Next, let's talk about an education credit. We'll talk about the refundable education credit, or at least a partially refundable education credit, and that's the American Opportunity Credit. This credit is for education expenses relating to the first 4 years of your post-secondary education. In addition, the person who is claiming the credit, or upon which the credit is being claimed, must be at least a half-time student and degree seeking. So this can't be a very part-time situation, can't be not sure what your degree is. This is someone who is focused, maybe not getting out in 4 years, but it's for the first 4 years of those expenses. The maximum credit is $2,500, and this is not a fully dollar for dollar credit. So the first $2,000 is a dollar for dollar credit. Then the next $2,000 is a 25% credit. So you would need to incur $4,000 to get the full $2,500 credit. And you notice here I'm giving you specific amounts. This credit is not indexed for inflation. However, it is subject to phase outs, and the income for those phase outs is subject to index for inflation. So be sure to check your textbooks for that. The last thing that I'll say about claiming the American Opportunity Tax Credit, and this is true really for any deduction and any other credit that we talk about, but just a reminder, this is for your net out-of-pocket expenses. So if you are fortunate enough to have a scholarship, a tuition waiver, if you're fortunate enough to have that money come out of a 529 plan where you're in effect paying for that with tax-advantaged money, those dollars do not count. So it would be a net out-of-pocket, post-tax, $4,000 would give you that credit. Having said that, most people who don't have grants or scholarships are using student loans, and student loan funded expenses do qualify for the American Opportunity Credit in the year that the tuition is paid. So even though your loan is being repaid in a future year after you have finish school, your credit is taken in the year that the loan funds are used to pay for those expenses. Next, we'll talk about the Earned Income Credit. This, again, is one of the most common tax credits that the IRS offers. However, it is unlikely that you will see this in your professional career as a financial planner. Now, if you're doing pro bono work, or if you happen to be employed by maybe a nonprofit that helps the underserved, you may see this more often. If you volunteer for VITA, the Volunteer Income Tax Assistance Program, you definitely will see this. But for taxpayers who can afford to pay a professional, whether it's a tax preparer or a financial planner, typically they're not going to qualify for the earned income credit, although occasionally I do have the child, the friend of a client who needs some help. Still, it's important to understand what the earned income tax credit is. As the name suggests, it is based on the taxpayer's ability to earn income. So the idea is, rather than sitting at home receiving benefits from the government, this is an incentive to help clients get into work. So not only do they get the wages from working, but they get a little bit of extra money from the government. So it is possible, in effect, quite often, taxpayers who qualify for the earned income credit, they don't pay any income tax at all. And in addition, they are receiving this earned income tax benefit. Now, I'll say one more thing before I talk about the rest of the qualifications. That does not mean that they're not paying taxes, because every employee pays Social Security taxes, has that money withheld from their checks regardless. There's no exemption from Social Security taxes, except for rare exceptions for students who are not U.S. citizens and children who are employed by their parents. But those are pretty isolated exceptions. Most U.S. citizen adult taxpayers, well, all U.S. citizen adult taxpayers are paying Social Security taxes. But we're focused on the income tax system here, and so we're talking about the earned income tax credit. Now, in addition to having earned income, and it's like a range, so you have to have a minimum amount of earned income, but then obviously as your income gets too high, it's phased out. And I say obviously because I think most of us have had earned income in our lives, and probably very few of us have received that earned income credit. So it's just a narrow range of income assistance to help people get from welfare to a job that can actually pay the bills. In addition, you can't have much unearned income. So this is not for a trust fund baby who gets a part-time job. They're not going to qualify for the earned income credit. It is not available for married filing separately taxpayers, and it is a refundable credit. So as I mentioned, a lot of times these taxpayers are not paying any income tax at all, and they're getting a credit back. Now, this sounds in theory like a great deal, although you have to realize that the amount of income that we're talking about here is not enough to really have a worry-free lifestyle, be able to pay your minimal bills even here in Tucson, Arizona, which is a pretty low-cost environment. Certainly in California, in the East Coast, in major cities, having the earned income credit is really not the answer to your problems. However, there is a lot of earned income credit fraud. It's talked about a lot. There is a lot of earned income tax credit abuse, unfortunately. And it's audited a lot. So as a tax preparer, if you end up signing a tax return, either as a paid preparer or even as a volunteer, you as a preparer now have to fill out a checklist saying, yes, you checked for documentation that the taxpayer really did have some earned income, because most of the time you think of tax fraud or tax evasion as people trying to reduce the amount of income that they report to the government. But with the earned income credit, there's this weird calculation where if you actually overstate your income a little bit, you can get more money back than if you stated a lesser number to a certain extent. So the IRS has tried to crack down really on the preparers who are not being thorough enough or preparing tax returns, which maybe they should know better, that the taxpayer really doesn't qualify. So just be aware, if you are doing volunteer work or if you end up working with clients who potentially are eligible for the earned income credit, that there are additional preparer certifications that you need to answer as well to make sure that everybody stays out of trouble. Last refundable credit that we'll talk about is a relatively new credit. It's the Premium Assistance Credit. Now, this is part of the Affordable Care Act, and as of this recording, the Premium Assistance Credit is still available. The government has threatened to disallow this credit or remove this credit. But as of today, as of this recording, maybe not when you're hearing it, the premium assistant credit is still available. So check with your textbook and be sure to pay attention in the live chat to see what the latest status is. But the premium assistance credit is put in place to help people with incomes between 0 and 400% of the poverty level, and that's different. So fortunately, this is one area where it is different depending on where you live. That 400% of the poverty level, you're eligible for a premium assistance credit if you buy your health insurance through the health insurance exchange. This can be a refundable credit, or you can actually go to the exchange and enter your estimated information and get the credit on the front end. So in other words, you're paying little or nothing for your health insurance if you pre-qualify on the exchange. Otherwise, if you didn't think you were going to be able to qualify or were a little bit confused or couldn't navigate that pre-qualification, you can claim it on your tax return when you file that return for the year. On the flip side, if you say that you're going to qualify when you sign up for health insurance, thereby not having to make premiums or making your premiums lower, and in fact your income ends up being higher than you said it was going to be, the IRS absolutely will notice this and will assess. It's not really a penalty, it's actually they'll ask for the money back. So it'll be not another tax, but just you'll have to refund the refund, basically. So we'll see what the next few years bring with all things Affordable Care Act, but this is the premium assistance credit as I know it today. So those are our major refundable credits, not a ton, but those are the ones that you're most likely to see. Now let's talk about a few of the most common non-refundable credits. So certainly in my practice, the most common, or one of the most common non-refundable tax credits that I see is the foreign tax credit. And this is not necessarily because I have tons of clients who are earning income in foreign countries. I have a few, but not a ton. But many clients, in fact, probably a lot of your clients, are invested in mutual funds or investments, ETFs, that invest in foreign countries, and a lot of those funds pay foreign taxes. That passes through to the owners. And so many of my clients have foreign tax credits just paid on dividends that they never actually are aware is happening. It's behind the scenes, but it's reported to them on their 1099. So as I mentioned, it can be on earned or unearned income. So if you do have a client that earned income overseas and was subject to tax on it, because not every foreign country taxes earned income or income of non-citizens, that income is subject to the foreign tax credit provisions as well. One thing though to keep in mind, a lot of times taxpayers believe that whatever the foreign tax amount is that they paid, say it's $100, that they will get the full $100 tax credit on their personal return. And there are some de minimis limits. If you're single, $300 or less, that is true, dollar for dollar, doesn't matter. $600 for a married couple. But if your foreign tax that you're trying to claim a credit for is more than $300 or $600, then there's a calculation that you have to go through. And really what this foreign tax credit is trying to do is making sure you're not double taxed. So it's really limited to what your U.S. tax would have been on that income that is also taxed by the foreign government. So for example, qualified dividends. In the U.S., your qualified dividends are going to be taxed at 15%, maybe 23.8% at the most. They may be taxed more in the foreign country. You are limited to the 15% or the 23.8% of that income because that's what your U.S. tax would have been. And then one further wrinkle, especially this comes into play with a foreign earned income, if you have income from significant income from the U.S. only and some income from a non-U.S. source, there's a ratio that is applied. And so bottom line, regardless of where your foreign tax is coming from, the foreign tax that is paid it is pretty rare that you're going to see a dollar for dollar credit, but it is definitely important to pick that up. And some states actually have a foreign tax credit paid provision as well. Arizona does, California does not. So be sure that you're aware of the tax credit provisions in your state too, to see if that's something that's available to your clients. Next, we'll talk about child and dependent care credits. Now, I mentioned that foreign tax credit is really one of the most common credits that I see. It's not that I don't have clients who are both working and are paying for childcare. Certainly I do. Most of my clients who are of working age fit that description. But this is a credit that is limited, severely limited by income. And it's not completely phased out. So for the highest income earners, you can get a teeny tiny credit. So refer to your textbook for the phase outs. But foreign tax credits are definitely more significant to my clients than the child and dependent care credit. Now, a couple other things to keep in mind. This applies for care of children under 13. So this is assuming once children become teenagers that they're fairly independent and don't require supervision care, or at least the credit is not going to fund that. It can be for a household employee, so some taxpayers might have a nanny or another person that they pay with a W-2. Those services are covered. It could also be for daycare, for after-school care. It's not for private school, it's not for education, but it's for child care itself. And the last thing I'll say is that both parents need to either be working or looking for work, which basically means each member of the couple needs to have earned income in order for this credit to work. So that's the dependent and child care credit. Next, we'll talk about the lifetime learning credit. We talked about American Opportunity Credit earlier. That was in the refundable section because depending on the amount of earned income a taxpayer has who's claiming that credit, part of that potentially can be refundable, although we don't see it refunded very often. Typically, it's like the last year that a student is a student and then they get that full-time job, they're able to take the credit themselves and get that refundable portion. The lifetime learning credit, in contrast, is never refundable. And there are some significant differences between the American Opportunity Credit and this credit in addition to non-refundability. The expenses don't have to be for the first 4 years. In fact, it's anything after 4 years. It could be post-secondary education. You do not have to be half-time. You don't have to be seeking a degree, but it does need to be something that improves your job skills. The maximum credit is $2,000, and this is an even less of a dollar for dollar credit. It's 20% of your expenses up to a maximum of $2,000. And the credit is subject to limitations and phase outs, just like the American Opportunity Credit, although the income limits are different. So be sure to refer back to your textbook for the most current inflation adjusted numbers. We'll briefly talk about retirement plan contribution credits. You probably will have clients who are making retirement plan contributions. That's part of the reason that they're coming to see a financial planner. But again, if your clients have the wherewithal to pay a professional, most likely their income is going to be too high to benefit for these credits. This is a credit that helps low-income earners save for retirement, but that credit is a maximum of $1,000 per person, which would be $2,000 for a married couple. And the phase out, the income phase outs are pretty low. So again, check your textbook for those limits. Could be a child of a client who's just out of school, maybe could qualify for this in the first year or two, or potentially maybe a student who is working while going to school would be able to qualify. Next, we'll talk about the child tax credit, and this is another one that kind of has a dual identity. So we've put it in the non-refundable section because most of it is non-refundable, but part of it potentially could be, depending on a taxpayer's income. The child tax credit is available for any child under the age of 17 who is a dependent on the taxpayer's tax return. There is a cap based on modified AGI. So if a taxpayer's modified AGI is over a certain limit, no credit is allowed or it becomes phased out. So it decreases to zero. And as I mentioned, for some taxpayers, part of that child tax credit can be refundable. But again, that's income specific as well. Now, we talked in a previous week, dependents are not just children. They could be either older children, 17 or older, or they could be adults. So for any dependent who's claimed on a taxpayer's tax return who doesn't meet the child tax credit requirements, there is a family tax credit that's also available. Now, it's not available for taxpayer and spouse, but anybody listed in that second section as a dependent who doesn't qualify as the child is subject to this family tax credit, same income phase outs, and it's never refundable, in contrast to the child tax credit, which may sometimes be refundable. Adoption credit. This is for net out-of-pocket expenses. So if you have a benefit through work that reimburses some of the expenses, those expenses would not be allowed. It's for your net out-of-pocket expenses associated with adopting a child. And the benefit is phased out for higher income taxpayers. So I do have a client who is going through the adoption process now, and she will not be eligible for this credit based on her income. So in summary, in this lesson, you learned that there are many tax credits available to taxpayers. Some are refundable, many are non-refundable. Most tax credits have income limits in order to benefit, and the eligibility and phase-outs vary by credit, so be sure to confirm the details by credit before advising your clients on the availability.